Many companies have retirement options available to you. Most of the time, it's going to be a 401k or a 403b. It's the opportunity to be able to put money in, tax deferred, meaning you don't pay taxes on it now, but you sure will later. Or sometimes you have a Roth option where you can put it in, pay the taxes today, but you'll never pay the taxes on the growth when you go to pull the money out. Should you or should you not use your 401k? And how much money should you put in? Stay tuned for Consider This Program. We'll tell you the answers. Well, good morning and welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Grant Sullivan.
Happy to have you along. Appreciate you taking the time out of your day to try to educate yourself about your financial future, your financial journey. Not everybody is listening to this program. Not everybody's paying attention, right? The old expression they used to tell me when I started in the industry was, you work hard today so you can do what others don't get to do tomorrow. I will tell you the same is true about your financial journey. You're choosing to listen to this today instead of a football game or something else you want to listen to learn more about your money, and we're going to make it worth your while. We are talking about how tax planning fits into your financial journey, to your life. And remember, a financial journey is a lot more than 12 months. It's a lot more than a quarter. It's a lot more than one day in a market. It is the time you separate from your end of your workforce, what I call separate from the workforce, all the way through the period of time when God calls you home. That's what we're talking about with the financial journey. I hope for you. Fortunately, I'm blessed with two young daughters. My journey should be longer than mine. It's mine, not just my journey, it's their journey. And we're trying to figure out how to pass assets on correctly. So we're going to talk about what's called a 401k. In your mind, because we'll say 401k, that's for a profitable entity. The majority of the rules are the same for what's called a 403b. That's for a not-for-profit. They're not identical, but they are very, very similar. So we got Grant Soliven. He's one of our senior advisors at the Financial Enhancement Group. He's going to break these down for you and try to explain what a 401k is. He is also an AIF. That's a credential that you may have not seen. It's accredited institutional fiduciary. It's his job, investment fiduciary. Okay. I said institutional. It's his job to be able to go to 401k plans and say, here's what you're missing, here's what you need to be considering, and here's what you need to think about. So we're going to go and turn the tables and let Grant tell you what a 401k plan ought to be like.
And Joe, appreciate that. When you're looking at a 401k, for many Americans, this is going to be their largest bucket of future assets for their retirement. Many of us do this through payroll deduction. So every 24, 26 periods, or if you're paid once a month or weekly, doesn't matter. The money goes into this retirement account on your behalf. And sometimes, not always, but sometimes you're given what's known as a match, meaning your employer is going to hand you a percentage of your income up to a certain percent as well to help benefit your future. And again, all that money going in from the employer match also is tax deferred. So we have some families, Joe, that say, hey, this match money coming in from my employer, is it tax-free? Unfortunately, no. It's going to be tax-deferred. But again, I always say free money. I'll pay tax on free money all day.
Always take free money. That is just the deal. So you've got employers who sadly offer no match. Mm-hmm. You've got employers who will offer a match up to what you contribute. And then Grant is fortunate enough to work for somebody who just puts money in their plan because Grant's cute. If you haven't seen the videos, you can go to YouTube and watch these videos. But we put in money. I believe everybody ought to put money in their 401k. So we put in 3% for everybody, regardless of whether they contribute or not. So you could have one of those three options, but always put into, in my opinion, what somebody will match, to get the free money.
100%. Don't leave that on the table. Make sure when you're signing up for your plan, or if your plan changes, figure out what that match is. Sometimes they can be slightly complicated percentage formulas, and it takes either you and a calculator or a fiduciary to walk that through. At the Financial Enhancement Group, it's a straight percentage. It's easy peasy. We know what we're going to get, but again, always take free money. For many of us, that's you have to put in to get, right? And so make sure don't leave that money on the table ever. Now, for some families, they're looking for to maximize contributions, right? So inside of the IRA world, you can make contributions. For those of us that are under 50, it's $6,000. For everyone over 50 at the time of this recording, it's $7,000. So if you and your spouse are trying to put contributions into a Roth IRA, for example, and your income, your adjusted gross income allows you to do so, you're in that lower level, you haven't hit the trigger mark to restrict contributions, then you and your spouse can put anywhere from $12,000 to $14,000 in. Well, let's say you're an individual who wants to put more in for your future. Maybe you're living well within your means or your income allows. The 401k becomes a really nice vehicle for stashing money away because anyone under the age of 50 at the time of this recording can contribute $19,500. And there's a catch-up, if you're over 50, to a total of $26,000. So for those of us who are looking to really jumpstart and or catch up inside of our retirement savings, a 401k vehicle can be a very powerful instrument for some of that.
So let's summarize this real quick, because this is what, in the IRS, when you make a distribution, they have what's called ordering rules. This is what my ordering rules would be for you for contributions. First thing you do is take free money. So let's say your employer gives you a 6%, if you put in 6%, they'll put in 3%. Well, and when I talk about 6%, we're talking about of your annual income, right? So you put in your 6%, so you get their 3%. That's a 50% return on your money. Let's not be silly, right? Even if they don't have a Roth option, you still do that. Hopefully they have a Roth option and we can get into another conversation. But if they're giving you, if they'll put in 3, and many times they'll call it 50 cents on the dollar up to 6%, a lot of different ways to structure that. You put in that amount of money to get the free money, right? Then the next thing, now you're going to look at the 401k and you're going to say, okay, what are my investment options? Because in all fairness, some are much better than others. We structure really good 401k plans, and in my opinion, I got a lot of money in mine, and it's all exchange traded funds, and I don't invest. All of my money is where all of our family's money is. I refuse to buy a holding that you guys don't own if I'm taking care of you. So my 401k is with the 401k plans that we have, that we take care of. We use exchange traded funds, not mutual funds. Don't let anybody tell you that they can't afford to do that. It's not more expensive. It's the structure exists today. And remember, the largest holder of exchange traded funds are mutual funds. So why in the world would somebody still put money in a mutual fund in a 401k plan? I can't answer that. Regardless, your first order is to put money in the 401k, get the match. Then you want to look at the investment options to decide whether you want to do that or use an IRA. Again, as Grant said, based on your income, right? Not everybody's eligible to contribute to a Roth IRA or even an IRA if they're still working. Actually, the Roth IRA has more flexibility than the IRA does based on the income limits. We can talk about backdoor strategies and things like that. That's how I'm able to contribute to the Roth IRA every year. And then once you've covered, so let's assume your IRA, because it's got unlimited choices, your IRA or your Roth IRA is the best place for the next dollar. Then when you have excess capital, then you go back to the 401k to be able to maximize that puppy out.
100%. And Joe, you're right on it. I mean, we call ordering rules. I'm a big food guy. I call it the funding cake. However you describe it, again, never leave free money on the table. Joe talked about using that Roth IRA, and even if there's backdoor strategies needed, it gives you certain flexibilities with future capital that we could spend hours talking about alone. And then again, make sure you maximize that 401k plan. Now, here's a funny, cool tip that people don't understand. If your 401k has a Roth option and you're in certain marginal tax brackets, it makes mathematical sense for you to put that money away in your Roth option. I suggest you talk to a fiduciary to kind of work through that math to make sure that the situation is right for you, but double check. Make sure the contribution you've elected is actually going to the right bucket. Guys, people who run these plans, they're human beings, okay? And human beings sometimes make mistakes. Do not forget to go double check your pay stubs with your contributions and your plans, because sometimes things get messed up and you'd rather catch it early on instead of later. Again, it doesn't happen often, but I just don't want you to be in that circumstance where you wake up one morning of $1 million and you thought it was Roth and it's no longer Roth. So just don't be stuck in that bucket, and make sure you use and make sure you adjust your 401k plan accordingly over time. right? The investment options you select in there may not be appropriate the following year, right? So adjust. Don't day trade. Don't hear me say day trade. But make sure you're evaluating your investment options just like you would with everything else that you got.
So when we look at this, I'm going to tell you my CPA, Ben Smith, who's been on this program before, that does my 1040, and then Huth Thompson up in Lafayette does our corporate return. They don't argue with me because they know it's futile. But I'm in the highest tax bracket you can be in, and I put money into my Roth IRA or my Roth 401k because I'm eligible to do it. The money that I put in as the employer has to go to the tax deferred side. And so people will say, Joe, at 37%, why in the world would you put money in the Roth IRA? Well, there's two reasons. And I want you to listen to this very carefully if you're blessed to be in that tax bracket to understand my logic. One, I believe taxes are going to go higher in the future because of the world that we live in and the situation that we're in. Two, we're eligible to put I'm 54, so I'm eligible to put the $26,000 a year in. So you put $26,000 a year in and you don't deduct it. I put $26,000 a year in and I've already paid the taxes. By definition, I put more money inside of my 401k than you did. And why the IRS can't figure that out, I don't know, but there is no issue around it. And so I'm able to build a whole lot more after-tax revenue inside of that 401k than other people are. But here's the biggest reason. The third reason is I need tax diversification. If you can tell me what the IRS is going to do in 25 years, then I will hire you. I don't know. Grant doesn't know. And I don't even think Congress knows, right? They're going to do all sorts of things that are going to come out. And what I want to be able to do is have choices. I want tax diversification. I want to be able to pull money out of tax-deferred accounts, taxable accounts, and money that is tax-free so that Barb and I can enjoy the life that we've worked so hard for. And I think you deserve to have that same financial journey where you're building tax diversification. You don't have to save $26,000 a year. Save what you can save. In the meantime, go to yourlifeafterwork.com. Get signed up for your Next Steps meeting. We'll give you things to consider about in your future, and if we choose to partner together, what FEG will do for you, and we'll put it in writing. yourlifeafterwork.com.